Hey everybody, how's everybody doing? This is Wells Only. Sorry for giving you guys a little silent treatment for a little bit there. We're gonna go live. Well, we're already live. We're gonna start in a little bit. Just so you guys are aware, this one is going to be a little more involved than usual. I'm gonna keep it very bare bones. Don't want to get too into the nitty gritty of the repo market and all of the nuances involved in it. Just gonna give people a little time to come in here. Let me let people know I'm actually live and all of that. Because I'm just like literally getting off of work. So give me a second, guys. Where is this thing? Hold on. Okay. Hold on a second. Where is this thing? So as you guys know, something happened yesterday that prompted me to want to do this live stream. And it's just more of the same, really. But the thing about it is just the timing of everything, right? And as I like to highlight all of the time, timing is everything. And when things happen, matter a little bit more than what is actually happening. Right now, we have a lot of funny things going on, right? We have a lot of centralization, a lot of the technocrats, the centralized authorities, right? Like they want what they want, even though it's not what we want, type of situation. So, this is just more of me bringing awareness to the community or the crypto community at large, just so everybody can be aware of what is actually happening, because it matters, right? We can't make the right financial decisions if we don't know exactly what's going on. And, well, not even if we don't know, but if we don't at least have some type of understanding of what is going on, right? So, right now, join us. Give me 1 second, guys. Okay. So again, I'm just gonna let people straggle in. I'm just gonna talk about what prompted this. And just to start, let me just say what's up to everybody in the chat. I don't want to be rude, of course. Just give me a second. Just to get into the into the actual chat here. Oop, sorry, guys. But yeah, this one is gonna be important, mainly because I think it's timely. As you guys know, there's a lot of funny stuff going on, really worldwide, as far as money goes and what matters and what doesn't. I mean, we've already seen, right, the aftermath of the centralized parties, right, and what they want for Bitcoin and all of that jazz, right? Like, we've already seen the end results of that. So, this is the kind of thing that we need to be aware of, that it's happening, that, these people are really just playing games. And it's not to sound any kind of way, it is what it is. And as you guys know, I've been talking about all of these same things really since I started streaming, and this is just really a continuation of everything that is currently ongoing, right? Just a different aspect that we really haven't touched on before. But the funny thing is that this aspect of the market, or the legacy markets, or just the global financial markets in general, is what will bring the global economy to its knees. But it's the one that we don't even talk about, mainly because it's primarily hidden in obscurity. They don't really want you to know it even exists, because it's not for you to know about. It's for the big players, because they're the ones that play in it. And once we start going through some of the material and exactly what is what and who is who and who are the players, it'll become a little clearer as to why you don't know about this market, but it'll even become more clearer as to why it's so important. Because the fact of the matter is that a lot of people, or let me rephrase, a lot of entities that you wouldn't expect do participate in the financial markets. And by that, I mean all of them. You wouldn't think of a Petco as the type, right? But guess what? Oh, wow. Already with the donations. Okay. Thank you, Desmond. Appreciate the super sticker. And it's a thank you with a pair. Uh, Thank you as well. And thank you to everybody for joining. I haven't really started yet. I'm just rambling. We are going to try to wrap this up by 8:30 because we have Maddie at 8:30. And he's going to do a very important stream that nobody's going to want to miss because, as you know, Maddie's the mental health specialist within the community that streams anyway. We have a few. And his goal is to get the community ready for what's coming, right? We already see how Hex is performing. We are seeing that the math does not lie. So, definitely tune into the streams. Check out everything everybody is saying on the streams, right? Because, we're at 7 cents plus now. Things are getting very serious, right? The price keeps going up, right? Like eventually people are going to need to stop showing their wallet on Twitter, right? Or wherever, right? Like you're going to have to start becoming a little more conscious about your operational security, right? And that's what OPSEC stands for. You don't want the wrong person to know that you're well off because, people that didn't know you are suddenly your best friend. And that's just the reality of money, right? I mean, we've all heard the stories, we've all seen it. Don't think that your life or the people you know are going to be any different because let me explain something to you about money. People in general do not understand it. And with that, right, we have to be cognizant of that simple fact because really that's all that is exactly what drives people to behave how they do about money. And that's why we talk about the mental aspect of it so much because it honestly matters more than everything else. Because again, I say this all the time. It's easy to make money, very difficult to keep it, however. And we see this all the time, right? When the so-called professionals are the ones losing, right, millions and billions of dollars in the financial markets. So with that, I just want to leave it with that. It looks like we got about 40 heads in the chat, in the stream now, in the chat, or watching now. So we will get into it. It's already about 6:53 Eastern Standard Time. There is quite a bit of material to go through. But let me get to it. All right, I think we already have a question about, I guess, Hex specifically. Let me just address that really quick so we can get to the meat and potatoes of the matter. And after that, I'll do a little roll call, a little chat roll call, see who's here and say what's up. And then we'll get right into it. Because I'm going to try to make this one quick, fast and furious because it's going to be that kind of stream. So let me see. First of all, welcome Bitcoin Buck. Let's read your question here. Please have patience with me. We welcome all newcomers, so no worries on that front. I'm ignorant about so much of this, and don't worry, a lot of those that own Hex still are. So no, don't feel any type of way about that. What is a 40% APY and is increasing Hex values to the moon? I mean, of help, but don't need to be the guy. So what's your question, brother? Do you want to know how the 40% APY is possible, or what exactly would you like to know? So we can answer that real quick and get into it. Let's do a little roll call in the chat. I'm going to start from the beginning to now. What's going on, Piston Broke, Marcavelli, Crypto Game Club 369. Thank you guys for coming through. Swaggy, what's up, man? Hexander, what's going on, brother? Odeli, what's up? Manufactured minds, you're talking tits. Cool, bro. Yellowtail, what's going on? Reggie Bone. Let's see, Yoden, what's going on, man? Appreciate the sentiment, the positive feedback from everybody. I really do. Thank you guys. It's partially why I keep doing this, because why else would I, right? So appreciate you guys, and you guys appreciating the work. Let's see. Can you buy it? No, I don't think you can buy this show, if that's what you meant. I don't know. All right, running OT, got you, crypto gains. All right, you're a Texican. Sorry, I missed this earlier. I wanted to say thanks and to the Quant Gang, through them, not to Kareem. Thanks to, of course, as you guys know, Quant Gang, me, Kareem, and Maddie, we do that every Tuesday night. And it's just really a chance for us to catch up on the week, what happened on the weekend, and what's going on. And we just talk about everything as much as we can fit in there. We usually stream for 5 hours because there's so much to talk about, because we're talking about everything that's happened from last week to that present point in time. So it's a lot. It's a lot, but it's good stuff. It's good stuff. What's going on, Big Gunna D? Thank you for joining. Mel Tony was good, brother. David Morales was good, man. Hex Mal, ¿cómo estamos, mi hermano? Because you guys, oh, well, thanks, man. We're glad to hear that. That's what we're here to do. We're here to educate and inform people of what the facts are and why they need to be involved in Hex, right? Because it's not about anything but the fact that Hex works. Hex does what it's supposed to do. And at the end of the day, that's all investors really care about, right? They don't care about anything else. All this other stuff about communities and blah blah blah. I mean, I'm a Hexican, right? Because I represent Hex and all of that. But at the end of the day, it's all bullshit. It's about dollars and cents, right? So let's always stick to the facts, and let's ignore the triviality of tribalness and community and all of that nonsense, because at the end of the day, that's not what's going to pay the bills. It's simply not. No matter who says what, right? And I think we've all been on this planet long enough to know that it is our own personal financial decision making that helps us succeed with respect to taking care of our financial welfare, right? Not who we hang with or anything of that nature. So, while it might be related, right, that's a different conversation altogether. So yeah, just keep up the knowledge gathering. If you guys have any questions, always reach out, because that's what we're here for. Balia Brand, thank you for showing up, brother. You're always at every stream. I don't know how you do it. Eximus Deximus, thanks for coming through, bro. Dylan Murray, what's going on, man? Thanks for coming through. Crypto's Gang Club, bro. You just a funny dude, man. Besot, welcome aboard. I'm not sure if I've seen your name before, but nice avatar there. All right, let's see. T-Bird, what's going on, brother? How you doing, man? Walter, thank you for coming through, brother. Yeah, I don't know how people do that either. Esteban, ¿cómo estamos, mi hermano? All right, I think we're ending. Identity Block, what's going on, bro? And Riapia TV, what's going on, brother? Hellcat Tony was good. Dolomite Hex, thank you for coming through. Hex Hound, thanks for coming through. Hex Phoenix, Devin C, Hextronaut, what's going on? Addison Coggins, welcome aboard. C Chef, what's up? The Excellence, thank you. Yeah, this is an impromptu one. Hex Toshi, ¿cómo estamos? Archimedes, ¿cómo estamos? UFO, what's going on, Stewie? Thank you for coming through, brother. Hex.Hound Axe, what's going on, my brother? If you want to join, let me know, man. I'll just throw you a link. I don't know if you're busy or whatever. I know you get it in. Blue Bum, what's going on, man? Thank you for coming through. All right, it's already reaching 7 o'clock. There's a lot to go through. So let me go through the stuff we need to get through. Diamond Dad, what's up? Cabana, what's going on, man? I actually do. I am old enough to remember that, yes. What's going on, Reed Mac? Yeah, this is a good statement, man, because, even though your name starts with Bitcoin, right, we're open to all people here, and it's a sad state of affairs when there are people in the crypto community that are looking for the actual escape, right? Like, crypto was made to escape the legacy financial system. It wasn't made well, Bitcoin, let me rephrase, Bitcoin was made to escape the legacy financial system. But Bitcoin ran into problems, right? Bitcoin ran into problems that, oh, wow, thank you, Hex Hound, for the donation. Bitcoin ran into problems, and I will put it up in a minute. Just don't want to get too deep into anything outside of what's the topic at hand here. But Bitcoin ran into trouble because people got emotional over Bitcoin instead of focusing on the mission at hand, which is to take back the financial system, right? That was the actual objective of Bitcoin. And I don't know about you guys, but it's pretty clear to me that they failed in that mission. They have no incentive, right? They have no intention nor incentive to want to improve the protocol. Any step that has been taken to somewhat try to improve it ends up becoming a battle of like ridiculous proportions, and it always ends up in becoming a fork of some sort or whatever, right? Like we know it's always some nonsense. But whatever. So this is why we have the rest of the crypto market now, right? And it's important to understand that because every crypto is not worth the code it's written in, right? And that's important for people to remember. And old technologies might die hard. Whoa, thanks for that, Axes. You guys don't have to do all of this donating. Buy the Hex instead, damn it. I mean, I know it's getting expensive, and the cost effectiveness of buying Hex is not as impactful as it used to be. But we're getting there, man. We're getting there. But yeah, so that's the whole thing about the crypto market, how it's evolved over time, right? Because Bitcoin has been around really since 2009, 2008, and we are still running into a lot of the same issues, right, in the crypto market that have existed really since the start. There's no interoperability, right? There's no this, there's no that. And interoperability became a thing when it was clear that Bitcoin wasn't going to advance, right? This is when the other chains and the other coins became a thing. And, in my personal opinion, that was really just the start of the end, right? Because Bitcoin, like, if you think about it, if you want to create a reserve asset, which is what the claim to fame for Bitcoin is nowadays, then, oh, thank you for the donation, Balaji. You guys are killing me. That's the name of the game, right? The name of the game is to escape the debt trap. It's hard to escape the debt trap when they're just replicating it on the crypto side. And that's ultimately what's happening. And this is why the information that we share in the Hexagon community is so important, because a lot of it highlights this, while the rest of the crypto gurus just rather ignore it. So, it is what it is. But anyways, let's get to it. Let me go through these super chats to see if I missed anything. Okay, so Hex Hound Axe, do you think we will get a sloshing effect between EHEX and PHEX for a period of time as traders chase price during discovery? I honestly don't think so. I think at that point, once both are live, at least from the outset, it'll be more so what chain do you want to be on? I think that'll be the choice at that point. Not so much, what, like, as far as price discovery goes, I don't think there's going to be much of a gap outside of the first few days, if that. And that's because the market is starting at 0, and Hex on EHEX on Ethereum is already worth 7 cents. So the notion of that lasting for a long time, not so sure it's going to be the case. Let's hope it does, right? Because I'd like to scoop up as much Hex as possible, but like most people, my plan is to have as much, right, sacrifice capital available for day one as possible. So I hope that answers the question. If not, just follow up. I won't ignore you. Just let me know. But I don't think that there will be much of an arbitrage opportunity outside of the first few days between Hex on Ethereum and Hex on Pulse. But we will see. Hopefully I'm wrong. Because there's nothing wrong with that. Thank you for the donation, Axes. I really do appreciate it, brother. And we are definitely getting this bread. That's for sure. That's for sure. Bala G, thanks, brother. Appreciate the bronze donation amount. All right, guys, let's get to it. What's going on, Crypto King, man? Thank you for coming through, brother. Let's get to it. Bree, thank you for coming through. Yeah, I'm not gonna speak on it. I'm starting to be like whatever, but we'll see. We'll see what the parameters end up being and all of that. At the end of the day, I think we all mostly want good assets, and ultimately that decision is going to come down to what you consider a good asset, right? Do you want to own infrastructure, which is Pulse in this case, or do you want to own a money printer, which is Hex in this case, right? And Hex is going to be the same whether it is on Pulse or Ethereum. So it doesn't really matter much to us because either way, we're getting paid. So welcome aboard, Sandy. Thank you for coming through, brother. And just to start with a little disclaimer, as always, you guys know I'm here to talk about math. And I know a little bit about finance, so I just share my experiences with respect to that. Nothing in this broadcast is financial advice, as they like to say. However, we do like to talk about the math, and the math does not lie. So consider it mathematical advice if you like. Just make sure you do the math and double check it yourself, because I am human. And even though I might seem like a human calculator, not really one. So let me read this little disclaimer that the information displayed in this broadcast is known to cause increased amounts of FOMO. Whales only and no guests this time around are not responsible for any losses you may accrue for having weak, puny, short-term staking hands. Remember, the big APY comes with the long-term stakes, meaning a stake of 5.6 years or greater, right? That's what's going to get you 30+% APY, not a short-term stake. So just to highlight that little important tidbit there. Badia, thank you, brother, for the donation. You guys are so generous. I appreciate it. I honestly do. I'll be buying a lot of Hex with this cash. So thank you. I'm glad I turned it on too. Apparently, people really want to donate. So thank you. Thank you to those that are joining right now. Crypto Learner, thank you. And Luis Hex, thank you. Benny Bills was good. So let's just jump right into it. What is a repurchase agreement, also known as a repo? This again is the topic is a little advanced, and it's a little advanced because the players in this market, as you'll come to see, are not you and me. What's going on, William? Appreciate you coming through, brother. The players in this market are big money, right? Fortune 500, Fortune 100, whatever, Fortune 1000, just whoever can afford to play in this market, basically. Commercial paper market is somewhat tied to this, but this is really just where companies come to borrow cash, right? Entities, whatever you want to call them, institutions that are looking to borrow cash short term, they'll come here if they know the market exists or whether they can access it, and they'll just borrow cash short term. That's pretty much just what it is. And now we're just going to talk about the technical aspects of it. A repurchase agreement is a short-term secured loan. One party sells securities to another and agrees to repurchase the securities later at a higher price. The securities serve as the collateral backing the loan, thus making it a short-term secure loan. So what does all of this gibberish mean? Oh, wow. Thank you, guys. I appreciate the donations. You guys don't stop. Thank you very much, Cash Plus. I appreciate the gesture. The same for you, Daniel. Thank you very much. It's my pleasure. I've never had a crowd. Wow, we have 77 people now in on the stream at 7 o'clock on a Thursday. So thank you guys, because this is very impromptu. I didn't anticipate doing this. As you guys know, I try to leave the streams for when people are going to be available, because this information is always important, and I want people to be able to at least catch it, or at least know it's on real time. During the week, it's hard for people to stay abreast of social media. So back to this. So one party sells securities to another. So a security can range from a treasury bond to stock, right? From the highest quality collateral, in this case being a U.S. Treasury, to the lowest quality, meaning a stock, any paper, right? So it's just important to understand that that's what securities in this instance means. So when a party is selling securities to the entity that is giving them cash for it, that is how it becomes a collateral backed loan, right? Because you have the securities as it's like any loan, right, that uses like say a home loan or a HELOC, right? A home equity loan is based on the equity in your property. That's it. So if that equity is there or it's lost, then guess what? You still have to pay that back, and it doesn't matter that the house isn't worth that anymore. So that's just one of those instances where you need to know the difference between what is actually backed by collateral, real collateral, right? Home equity isn't really collateral. It's just whatever, right? It's just thin air. It's a valuation that the market gives it, and it could disappear tomorrow, even though it's there today. Uh, that grown. Thank you very much for the $5 donation, brother. I really do appreciate all the donations, guys. You guys are surprising me. It's crazy. And yeah, uh, this is one thing that is happening real time for everybody, right? Most people that are getting into Hex are finding out that a lot of the sources that they thought were now this is funny. Thank you for the donation, David Morales. You guys are killing me. So all the sources you thought were legit, you are quickly discovering are anything but, right? And that's very important because this is exactly what is happening worldwide, right? And this is kind of what my streams highlight in a lot of ways, is just how everything that you think is true is not, right? So let's keep talking about this. The interest on the loan is the difference between the initial price paid by the buyer of the security, right? The entity lending the cash to the entity that's selling the security, right? And then the repurchase price paid by the seller of that security, right? So a reverter now. I hope any of that made sense, because I know it's a little weird, right? So let's put it in English. Uh, let's say you have $100 in U.S. Treasury notes, bonds, whatever, $100,000 to make it a big number, make it more realistic. And let's say you don't want to sell anything to get cash, but you don't have any cash on hand, so you need cash to do something. You would then take that $100,000 in U.S. Treasury notes, sell them to a counterparty, right? And then at the same time, agree to repurchase that same $100,000 in Treasury notes at a higher price later, right? And this is how it becomes a short-term secure loan, because you have to understand that even though it's $100,000, you're not going to borrow $100,000. You're going to borrow what you need with respect to the rate that the market is setting. So if you only need $80,000, right, you'll borrow whatever the market is giving. Let's say it's giving 97 cents on the dollar, right, for those $100,000 in treasury loans. So you're getting $97,000 instead of $100,000. And then the promise to pay back is 99 or 98 and a half, right? So you have to pay back the interest, which is going to be 1.5 basis points here, or 1.5 cents, 1.5% back on that loan. But you only needed 80, right? So you're not taking a loss. You're just using your cash for whatever. You didn't give up your treasury. You still have your 100,000 in collateral. You only needed the 80. And let's say you use that 80 to make a quick cash flow move to generate a return, right? You needed to buy something to generate a cash return somewhere else, and this is why you use that money, right? So you borrowed 80,000, used it to buy something that you ended up selling to make, let's say, 20,000. There's your 100,000 again, right? Boom, you're whole. You pay back the 17 or 18.5 that you have to pay back, and you still have 1.5 in your pocket, and you never gave up anything. So you even made money on the repo, right? Now that might have sounded like too much, but let me know if it does. I'm really trying to make it as simple as possible, because all you're doing is, instead of selling an asset, you're taking an asset, making a short-term loan against that for the cash that you actually need. You use that cash, pay it back at the end of that term, and you get your collateral back. That's all that's going on here. Wow. All right. You guys are really blowing up the donations. Thank you very much. I'll buy myself a Sour Patch. They are some good gummies. And thank you, Crypto King, for the donation, man. I appreciate it, brother. Uh, Thank you. Thank you for the kind words. I'm just here to just share the information, man. Thank you. Thank you very much for the donations, everybody. So let's talk about a reverse repo. A reverse repo is merely the opposite of a repurchase agreement. So what does that mean? Instead of a party coming to sell a security to another, that means that the opposite is happening here. A party is coming to buy a security from another party, and then they're promising to sell it back later at a higher price. So let's get to that. It gets confusing. Even when I talk about it, it still confuses me. But what are we gonna do? So let's just talk about the risks inherent in the market. They're primarily credit risks. So what does that mean? Here we have two entities, right, coming to the table. You have borrowers and you have lenders, right? At the end of the day, these are short-term secured loans. So there's not really much inspection going on with respect to what is actually happening at the balance sheet level. So what does that mean? That means that if an entity is not secure in its financial position in terms of cash and in terms of assets and liabilities, let me rephrase, that means that they could go bankrupt, and you might not even be aware that that's a possibility. But guess what? They're bankrupt now, and you're not going to get your collateral back, or whatever the case is, right? And if you are, it's not going to happen right now. It's going to happen later on, because now you have to deal with this whole arbitration situation, right? Like if the company is going bankrupt, that means they can't pay you back. So then it becomes a long, drawn out process. So that's something that's important to understand about the repo market and where the risks lie, right? Because as I go through this, it's going to seem like there's no risk, but yes, there's plenty of risk, and we'll get to that. All right. So what is a reverse repo agreement, a reverse repurchase agreement? A reverse repurchase agreement is the opposite of a repurchase agreement, as I just stated. One party buys a security from another and agrees to resell that security later at a higher price. So now we're going to talk about kind of the mechanics of what all of this is, right? You have a dealer in the middle always, right? And the thing about it is that we have to realize who these dealers are, right? These dealers are the intermediaries that are there to facilitate a lot of what is going on in the markets, right? On both sides, the buy side and the asset management side, right? It's very, very important because, you know, you have liquidity providers on both sides, right? But the question becomes, well, what kind of liquidity is being provided, right? Because here's the thing that's difficult to understand for most folks. Even us as Hexicans, right? We're providing liquidity to those that want to sell at all times, right? That's a reality. Anytime somebody is exiting Hex, they need liquidity in order to do so. And the only way for them to attain that liquidity is by somebody being there to be willing to buy that Hex that they're willing to sell. Otherwise, who are they selling to? Nobody, because nobody's there. So, you know, while it seems like it's all automated and there's nobody involved, yeah, there's people involved, and you can't avoid that. Even if there's a bot behind it, right, that somebody has to turn that bot on. Nothing happens by itself. So it's very important that people understand that mechanism of markets and how they work. Because without that, you're going to be flying blind. Oh, my God. Sorry, guys. Give me a second here. Sorry, guys. Sorry about that. So back to it. So now we're going to talk about basically how money flows in a repurchase agreement. We already talked about the characteristics of a repurchase agreement, but now we're going to talk about who the players are and how the money flows, right? Because that's ultimately what matters. That's ultimately where the risks come into the market. And, you know, this is also kind of how things reverberate, right? From the lower level to the from the lower level of the markets, meaning like the short-term plumbing, right? Like the plumbing of the market, because repo is really a function of the plumbing, similar to the stable coins that we have in the crypto markets, right? When the stable coins are going down, that means that people are selling the collateral that they're using, right? In this case, stable coins, to take on risky assets, in this case, cryptos that are not hex, right? Um, and I think we've all learned that lesson the hard way over the past couple of months, because while everything has been dumping since basically the middle of April, hex has been going up and to the right like it's supposed to. So it happens. So now let's talk about the dealer and what his part is here. So a regular repurchase agreement, we have a party selling a security to another, right? And then agrees to repurchase the security later at a higher price. A reverse repurchase agreement, a party buys a security, right? They're not selling it, they're buying it from another party, and then agrees to resell that same security later at a higher price. Now, I remember the first time I learned this, the first thought that came to mind was, well, why the hell would anybody buy something to give cash? It didn't make sense, right? And that was because I didn't understand the player that was doing that. And we'll get to that on the next slide because it's very critical. If the dealer borrows fiat, right, it is a reverse repo. If the dealer lends fiat, or I'm sorry, I said that wrong. I just have reverse repo on the mind because that's really the most important aspect of this market right now. If the dealer, so let me start again. If the dealer borrows fiat, it is a repo, right? Because what's happening is that one party is selling securities to another, right? And when the party is selling securities, they're giving cash to that entity that's selling the security, right? So in this case, the dealer is giving the security. Wait, did I write this wrong? Yeah, I think I. No. I'm just thinking about it wrong because I'm thinking about it from the other perspective. So this is the dealer, right? So if the dealer is borrowing cash, that means they're taking on collateral, right? If the dealer is lending fiat, like it's noted here, one party is buying securities from another and agrees to resell it later, and they're lending fiat, right? Shit, you know what? I think I wrote that down wrong because the dealer. Well, I'll rehash that in a little bit. So who uses the repo market? And okay, so let me go back to this. The reason I say this doesn't matter will become clear in a slide or two. So who uses the repo market? Entities such as hedge funds, asset managers are typically on the borrowing side of the transaction, meaning they're borrowing cash by lending securities, right? So in this case, they're borrowing, right? They're the dealer here. They're borrowing fiat because they're giving up collateral, right? So which entities are on the opposite side of that? Entities such as money market mutual funds, corporations, municipalities, etc. They're on the lending cash side because guess what? They have the cash to lend and they need to earn on that cash because I'm sure all of you guys have heard Mr. Saylor give his, Bitcoin is the best treasury asset speech a million times by now. And this is the purpose behind that, right? This is the purpose behind that. This is just another way that institutions go about generating returns on their excess cash or on their cash reserves. That's all that this is. So who are on both sides of the ledger, and why is that even possible? Well, let's get into it, because this is really what begins to introduce the risks into the markets short term, and this is what causes market dumps, market pumps, right? Because everything works both ways. So you have securities lenders, central banks, hint, hint, commercial banks, hint, hint, and insurance companies, hint, motherfucking hint. They're on both sides of the market, right? So just to get this out of the way, the term for repos are typically from 1 day, which is known as an overnight repo, to 1 year, which is extremely long term, but the majority of them are 3 months or less, right? And the reason for this is, now this is going to get a little accounting-y, but it's important to understand. The reason that most of them are 3 months or less is because you have to understand what assets are being treated as collateral, right? In this case, nowadays, you have a lot of instances in where high quality collateral is not high quality collateral. So what does that mean? That means that entities like the Fed, the ECB, you know, central banks, they'll take on collateral that is just subpar, substandard, like let's say any triple B credit, right? Or let's talk about Europe is a prime example really for this. And if you guys don't know, they have this big program over there called God, I can't remember the name, but it's like LT Repo or some stupid name. I can't remember what it is anymore. But long story short, it's a long-term repo program that allows entities to give up their trash collateral, and I think they even take stocks in that ridiculous program. Because again, this is the EU, the ECB, and they just do whatever the hell they want over there. They don't care. The negative rates have existed over there since like 2015, 2016, or 2012. I can't even remember how long it's been. It's all a blur for me at this point. It's been so long. But this is what they're doing. They're taking trash and making it cash, right? And this is exactly, oh, well, look, T-Bird basically said that. They're borrowing trash in order to collateralize trash. Yes, and in many ways, yes, that's basically what they're doing. And yeah, when entities are giving up high quality collateral, they are looking to increase their buying power without selling off assets. That is correct. That is correct. And the reason most of them are 3 months or less is because, you know, one, you don't want to expose yourself to price movements for longer than that period if you don't have control over it, right? And the reality of the matter is that nobody can control the price of treasuries, right? Treasury securities are still just that, a security, meaning that they will be priced with respect to what is happening in the market, not with respect to what people want to believe. It's a security, right? Meaning that if things change, the value of that thing will change. That's basically what a security means. And this is why you always hear Richard Hart harp on no promises from the work of others, because then guess what? Things change. And this is what, just to talk about Hex, makes it so superior, right? It's a product. It is not a security. It is a financial product that does one thing and one thing only, and that is generate yield for those that inject economic mass into the system. So that's the difference right there, right? It's very simplistic. There's no reason to get into the legal nuances of it because it really is that cut and dry. The rest of it is really just all filler. And as you guys know, these folks love filler when it comes to legislation. So we'll just keep it moving. Let's see what else is here. Okay. So this is the important part. This is where it gets hairy. How do central banks ignite risks via the repo markets? And here's the thing. We have seen what's been happening, right, in legacy markets since 2009, 2008, right? Very, very important. Oh yeah, check this out. I think Axis, correct me if I'm wrong. That might be the tweet that started the thread that Freddie Quotes did this morning, explaining what it takes to get Hex and $10, which isn't really much at all. If I'm wrong, let me know. But if not, you guys should definitely check that thread out from Freddie. it brings a lot of things to light, given that we're pretty much at 10 cents and it's really just what a 100x from there to $10. I mean, what is that? That's nothing. Especially given that Hex does 350 plus on a yearly. Well, at least in year one it did that. I'd be surprised if it didn't at least go halfway. And I actually wrote a little something about that the other day too. I think as of now we might be 3x.5 on the year, 3.5x, maybe 4x on the year, because we started the year at 1.7 cents. So on the year we're only up 3.5, maybe 4x, 3.75x. Okay, that is the one. That is the one. Thanks for confirming, Access. Appreciate that. So you guys definitely check out that tweet. You're gonna want to check that out. Yeah, who determines what piece of paper is high quality collateral? We're gonna get into that, because this is exactly what this is about, and this is why I started talking about the ECB here and what they determine is high quality and what isn't. And we'll be switching back and forth between these slides, because these are really the crux of the conversation that we're going to have today. We got about an hour left. I'm going to really try to push through this, because this is a lot of technical information, and I'm really trying to make it as basic as possible, because the reality is we don't care about the nuances. We just care about the magnitude and the effects of what's happening, right? Like, we don't care about the nitty gritty. We just care about what the effects are going to be, because we're properly positioned for this already to blow up. That's what people need to understand. If you own Hex, or really any crypto that's worth a damn, you're properly positioned for this to blow up already. Let me correct you here, T-Bird. Money is not debt. Fiat is debt. The legal tender that we use is debt. Because what people have to understand is, if you read most of these monies, fiat currencies that we use as money, they are not money. They are fiat, meaning they are based on trust. They are credit instruments. They are notes. So money itself is not debt. The currency that we use as money is debt, however. It's very important to understand that difference, because you're right. The money that we do use is a promissory note, but it's just not our promissory note. We're the ones that are beholden to that promissory note. And that's the issue that many have a problem wrapping their head around when it comes to money, because it doesn't make sense at all. It doesn't make sense at all. And when you think back to when you were a kid, if you can remember that far, money doesn't make sense in the way that we use it, in the way that it's described, and to the way that we know it. Thank you, Crypto Hut, for the donation, man. I appreciate it. If you guys haven't checked out this dude's store, definitely check it out. He has a lot of good crypto goodies there. Like a lot of pretty cool stuff that you just won't find elsewhere. Nitpicks and knickknacks, like the lamps and just cool coins, like physical coins, just really cool stuff. Check it out. If you're into crypto memorabilia, check it out. Thank you for the donation, Hextoshi. I appreciate that, brother. I appreciate that. T-shares repo us more Hex until our stakes end. And that's exactly right. That's exactly right. That's exactly what's happening here, right? The T-share in this instance is the dealer. We're giving them the trash, which is the cash, or Ethereum in this case. And we're taking the good thing, the high quality collateral, which is Hex. We're exchanging it for T-shares, which is just yielding us more Hex. And at the end of our stake, we're promising to repurchase that Hex back in exchange for giving the T-shares back. But then in order to get back into it, right, we have to pay again to reclaim those T-shares. And that is what makes it important to understand the long-term game here. I mean, it's funny because I've thought about Hex in this format before, and I just have refrained from using it because, who the hell wants to talk about repo markets, right? It gets pretty hairy once you get down past a certain level. And we're about to find out why. So why do we have reverse repos when in reality you should really only have regular repurchase agreements. And the reason why is because, the system is centralized. And that's really all it boils down to. When something is centralized, there has to be something there to prop it up because there is no value proposition. You understand? So when there's no value proposition, right? Because we know. So let me go back a little bit before I even get into this. So we have to understand that all of these markets surrounding the dollar exist because the dollar is a weak currency. People have to find ways to stretch the use of that currency because as time passes, the value of that currency depreciates. And this is why we have all of these markets, right? You need to find a way to circumvent the reality that we live in an economic system that is designed to shaft us over time. That's really all it is. This is what the time value of money is inherently saying, right? In nice words. A cent today is not worth a cent tomorrow, right? And this is why, these entities lend cash, right? This is why they're looking, right, to make cash on their cash. Now let's talk about this, right? The dealers, i.e., central banks, securities lenders, whoever, they'll always be in the middle and also on the sides because they can be, right? Because they're just receiving and dictating flow more than anything. And why does this matter to us? It matters to us because when there's a central bank involved, that adds a whole new leg of fuckery with regards to what's going on, right? It's next level because you have to understand that the central banks are the entities that price the money. So they are the ones controlling the value of the assets. They are the ones controlling the value of what your income is. They are the ones controlling the value of your cost to borrow fiat because fiat itself is inherently bad. It's trash, right? It cannot maintain its value. And this is why I go through all of these explanations that are very drawn out and not concise because there is a lot going on beneath the surface that we have to understand before we can fully grasp all of the games that are being played at the surface. Because at the surface, things look one way. And then the further down we dig and we look, the more we realize those things are anything but. And that's why all of this stuff is important to talk about, right? So as we talked about earlier, you have entities such as hedge funds, asset managers that are typically on the borrowing side of the transaction, right? That means they're giving up collateral and receiving cash, right? Which is what we highlighted earlier, which is a regular repurchase agreement where one party sells securities to another and agrees to repurchase them later at a higher price in the interest of receiving cash for that collateral backed loan. Okay. And I hope you guys are enjoying the music in the background. I mean, I live in the Bronx. What are you going to do? Windows are open. The weather's nice today. I don't really like AC, so just please bear with the noise if you may. If it gets too loud, just let me know and I'll shut a window and go turn that AC on. Because either way, I'm not losing really, right? Yeah, that's right. That NYC life, baby. That NYC life. And let me tell you guys, this is not high at all. This is actually pretty low. Yeah, the weather is great today. I'm upset that I'm streaming, but hey. Mi hermano, no abuse. Thank you very much for the donation. Despide tu jefe. I appreciate it. I appreciate the kind words, man. And I do it for free because it's worth doing. I just want people to understand that I'm just here sharing important information that is really going to help you make the right decision with respect to what is coming, right? Because this is all really a series of streams that's detailing how you want to be positioned, how you want to look at things, and how you want to think about things. I can't tell you what to think, but I can sure as hell tell you what's going on and help you understand. Sorry, I'm still getting used to the super chat, so I thought I needed to unhighlight it. So this is why it's important to talk about these things, We need to understand what's happening in order to realize where we're going. So again, the entities that are looking for leverage are the ones that are doing the regular repurchase agreements, right? Which is a short-term secured loan where the securities serve as collateral to back the loan because they're just looking to receive cash. And that's it for their collateral. Now, reverse repo is on this side. But the thing about it is that this graphic isn't showing it in that way. But that's exactly what's going on, because what's happening is that a reverse repo is flipped, right? A reverse repo, you have an entity taking securities on from the dealer, which in this case shifts to become the hedge fund or whatever entity. It could even be an asset manager in this instance. And then they would then be receiving securities from the central bank. And oh, I'm sorry, I'm saying that backwards. This is just all retarded. And you're gonna, like, once I'm done with this, you're gonna see why. Because it just doesn't, like, a reverse repo doesn't make sense if the whole objective is to allow parties to lever up with what they already have on their balance sheet, right? And the balance sheet, as I've detailed before, numerous streams in the past, is just basically our credit report, right? That's how we determine what's good money, what's bad money, as far as borrowing and or as far as lending goes, right? Because this is a function of lending. So this is what's difficult about the repo market, right? In reality, any entity can be doing a reverse repo, right? Which is where the entity is buying a security from another and giving that entity cash, right? In reality, any entity can do this, but the incentivization isn't there, right? The incentives are not there to cause a hedge fund to do that, because a hedge fund is there to make money, not give up money, right? So why would they give up cash and take on a treasury? Doesn't make sense. Their objective is to give up a treasury as collateral, to borrow money to make more money on the positions that they currently have. Like, say, I'll give you guys a good example that's realistic. Say a hedge fund is long whatever, some stock, right? And let's say they have, like, the manager, whoever the portfolio manager is within that respective hedge fund, sees an opportunity that he didn't anticipate initially. And he wants to add on to his position, but doesn't want to sell any of his other positions. Let's say he has a 10 position portfolio, for example, right? So he only has 10 things he could deal with. So usually, even though you have a 10 position portfolio, you're going to have some type of asset mix that's going to allow you to be able to take advantage of this scenario where you maybe have 5% in cash or something of that nature. And 5% is high, just so people understand that. So what else is being said? The entity looking to lever up, right, is looking to lever up for a predetermined period of time. And as discussed, that can go anywhere from 1 day to 1 year, but it's usually 3 months or less. So let's say this is a 1 month endeavor for the hedge fund that they think that the price is going to break out, say, for a month's time, or it's going to give a decent move for a month's time. So they want to take some treasury collateral, repo it, and obtain some cash and pay it back because they think they're going to make more than whatever the cost of that capital is going to be, right? And for a repo, it's typically pretty cheap. It's not, rarely is it, 3%, 4%, 5%. It's just not the nature of that market. They're short-term loans, so the APY could read whatever, but the cost is really in basis points, percentages of percents. You're not going to really be paying a high APY because, again, it's a collateralized loan to boot. So that is basically what makes sense, right? An entity is looking to borrow cash to lever up their position, right? Yes, basically. So yes, Dylan Murray, reverse repo means that not necessarily a hedge fund, but any financial entity, and it's usually a central bank or something of that size, right? It's usually going to be a big entity they're buying collateral. They're taking collateral, or I'm sorry, they're taking on collateral from the market, right, in lieu for cash, right? So one party is buying the security, right, and agrees to resell it later, right? And that's the thing that's weird, right? When a central bank sells the security back, right, because they're buying the security from the seller, right, and they're injecting cash when they're buying it from a seller, right? So this is the normal process, right? This is a repurchase agreement. When a central bank buys the security from a seller, it is injecting cash into the financial system, right? So a reverse repo is the opposite. The central bank is now giving an entity cash for that security, or it's taking cash from the entity for the security. It's giving the security back, right? So it's draining cash from the financial system. It's removing cash. That's the difference between a repo and a reverse repo, right? In a regular repo, cash is being added into the system, and in a reverse repo, cash is being removed. So when cash is being added, securities are being removed. And when cash is being taken away, securities are being added, right? So currently, what prompted this forecast, or this stream, is what recently happened, which was just yesterday. And we'll just get into this just to talk about it a little bit, just so you guys can kind of see where I'm coming from. You are too funny. Yeah, everybody seems to be a thing with my voice. I don't get it, but I don't hear myself, and I don't like how I sound. So I think most people can jive with that. Yeah, pretty much. Yeah. So from the regular repurchase side, not the reverse repurchase, from the regular repurchase, that is exactly what's happening. People are taking collateral that they have on their balance sheet, putting it up for a short-term loan to borrow cash. A reverse repo is the opposite, where you have a centralized entity removing the cash and giving them back their collateral. That's what's happening here. So yesterday we had this print at 11:46 a.m. It was major because this is typically when the window closes, around 11 a.m. Eastern Standard Time, or maybe 10:30. I can't remember anymore. For the repo window, all these repos happen in the morning, right? Because entities want to, or the central bank wants to. Well, let me go back to this real quick before we get into this. So central banks can use repos to set. To set monetary policy. It's really not just set. It's really set or conduct. Give me a second here. Why is this being a pain in my ass? Sorry, I just forgot this here. All right, there we go. Where are we? All right, yeah. So central banks can use repos to set and conduct monetary policy, and that's why this is important to talk about. We need to know what the central bank is doing at all times, because that is how we're aware of what's going on. You don't want to get caught with your pants down, ever. And that's the important thing that we have to realize. So this is why it's important to understand the central bank function in the repo market and how they could ignite risks, right? So if a central bank buys a security from a seller, i.e. a party that's trying to leverage their balance sheet, then they're injecting cash into the system. That's a function of the Fed creating inflation, right? Because what they're doing is that they're now adding more dollars to the system, right? Or any fiat to the system. And at the same time, they're removing, right, the high quality collateral from the system, because now that entity that used it for collateral can no longer sell it, right? They just locked it up with the Fed. That's what just happened there. So now the contra to that is the central bank selling a security back, right? Them creating now liquidity. Now they're providing liquidity to the high quality collateral market, right? Whatever central bank it is, whatever that collateral is, they're now essentially suppressing the price by selling that security back to that entity. Now, what do I mean? Even though it's not direct, it's indirect, right? All of these effects are indirect. And this is why it's important to kind of understand what's going on here. So when a central bank sells a security back, it is then removing cash from the financial system. And that is now creating a dearth in the fiat, right? So now they're kind of creating a liquidity crunch to a degree, because now the liquidity is happening in the cash that's outstanding in the market, right? Now, these entities, when they need cash, right, those that were borrowing to get cash, well, guess what? Now, in order for them to get cash, they have to do what? Sell that security, because the centralized power is no longer buying that security for cash. You understand? So it's pretty important what's going on when the Fed is saying, hey, we're going to drain $500 billion in freaking cash in one day, right? You guys hear me snapping these fingers in the background. I mean, this happened in one day. That's pretty significant, because then the question becomes, well, okay, so what are these people going to start doing when they need cash now? Because here's what you got to realize. Sorry, guys. Right, we have, well, let's go to the futures just because that's what I like to look at. We have, oh, did something happen? Did the market flip? Hold on, let me look at the actual live E-mini S&P. Yes, just want to make sure that's not a gap down, because if it's like, okay, all right, not a gap, let me make sure. Oh boy, okay. So I don't want to get all super bearish on the stream live, because it usually is hard to call it, but this is not a positive type of open. And what I mean is, I don't want to get into that. I don't want to get into that. Let's just keep moving. Let's keep it topical. So, all right, let me go to the regular market now that I've confirmed that that is not. All right. So as we look at the S&P 500, this is just a futures market for the S&P 500. What we can see is that, oh boy, what's going on? Oh, it's because it's logged. Give me a second, guys. Let me just fix the settings. Oh, okay. So as we look at this profile, right, each histogram is letting us know the interest in the market at that price level, right? And as we zoom in, we can see that the interest up here is relatively new. There's really nothing above here, right? There's nothing to really give anybody any assurance of anything once you get past the current all-time high, which at present is 42.49. And you see that right here in the 52-week range for the E-mini S&P 500 future. Yeah, 42.49. So we have all-time highs. We have extremely low momentum, right? And the last time we had extremely low momentum like this was back in the 2014, 2015 time frame. Right, we can see it right here. And what ultimately happened wasn't anything major, because as always, you know, they're there to prop it up, right? They're there to prop the market up. We had just a measly 15 to 16% down move in the summer, I think it was. Oh no, wait, was that? Hold on, let me make sure I'm remembering the correct event here. Yeah, that was the summer of 15. Yep, summer of 15. Then come December, the Fed basically locked it in, letting everybody know that, they were going to prop the market up again. So it just reversed course. That's all that happened here in early January 2016. But ultimately, this was born out of the same type of scenario. Financial stresses in the market at the plumbing level. You know, it's kind of crazy. It's kind of crazy because this is just what's going on, right? I mean, look at this momentum just lagging for the past year. This is just momentum lagging for the past year. And luckily for the S&P 500, price is above the middle band. And as you guys know, the middle band is what determines bullishness or bearishness. Above it means it's bullish, below it means it's bearish. But let's keep in mind the fact that momentum is decreasing over time, right? What we're seeing, and this is every bar is a week here in the histogram, right? So over time, this was basically, this was basically the highest point in time for momentum from a MACD perspective. Hold on, guys, because these damn fuckers don't stop with their fire trucks and shit. So back then, this was the highest point of momentum, right? February 25th, the week of 2019, right? And since then, momentum has been down. As far as the trend goes, it's a downward momentum, right? And look at what price has been doing since that time. Just straight up with a menial drop, thanks to what we remember happened at the beginning of 2020, which was a precursor, right, to all of this. And I don't know if you guys remember, but we had a nice little pre-market dump shock in the fall, which you're seeing it right here. Let me just go to it on a daily basis so it's clearer to see. Yeah, I think this is it right here. So the market was already showing trepidation going into the 17th of September, which was the date in which we had the repo markets almost seize, right? So what happened that day? The lending rate was 10%, and in line with that, so was the borrowing rate, right? Because they're one and the same. Now, why does that matter? It matters because nobody was participating in the market. And as I just previously described, right, when you don't have anybody selling or buying, that means there is no liquidity in the system because everything functions from that. Literally, everything functions from within that. That liquidity in the system is a function of what people feel is optimal or not optimal within the short-term risk of operating within such a system, right? And this is where you get these short reverberations from, which really should be long ones, but they end up not becoming such because the centralized authorities are there to pick up the slack, right? And it's on our backs, right? Because we're the ones that, even though they print money out of thin air, we still have to pay taxes. We still have to do this. We still have to do that, right? So this is where inflation comes from in a lot of instances. This is also where taxation comes from because, again, we have to remember, we're not using money. We're using promissory notes as money. We're using legal tender as money. We're not using money. It's very important people understand that. Do not be confused by that because that's not what's going on here at all. So let's go back to, let's see here, February, September, here we go. September, okay. So look at the week of September for the 2-year. And the reason I want to look at the 2-year is because it's the shortest term that we can look at graphically, right? So going into that date of the 16th, 17th, rates were shooting up, right? Which is in line with what we were seeing in the S&P 500 at the time, which was price going down. Because remember, the cost of capital is what determines what people are able to borrow to lever up to continue buying or selling, right? And this is exactly what this is saying. When a central bank sells a security back. Oh, well, I wrote that all wrong. Sorry, guys. Where are you? PowerPoint, where are you? Why doesn't the PowerPoint want to populate? Okay. Give me a second, guys. I'm just trying to pull up this PowerPoint and it doesn't want to. All right, here we go. Just need to fix what this is saying. When a central bank sells a security back, it is draining cash from the financial system. Sorry about that, guys. A lot of copy paste errors there. But yeah. So that's what's going on there. Right. So that's why it's important. Jesus Christ, man. Sorry, guys. So that's why it's important to understand where these moves come from and how they happen, right? A lot of the moves that we get short term in the market are because of how the market comes into existence in the first place, right? And this is why it's important to understand the implications of this, right? This isn't straightforward. It's something that comes in a second, third order effect. It's not something that has a direct effect, and that's important to understand. So yesterday, we had 500 billion in cash get drained from the market, right? That's basically what happened yesterday, right? And now, why is this important? It's important because this could lead to further changes and ripple effects in the market over time, right? Because what does that mean? What that means is that now it becomes more expensive to participate in that repo market, right? And this is what we're seeing here with this red line as the rate to participate in that market goes up, right? It used to be cheap. Now it's going up. And this is just May, right? This isn't even up to date, or maybe it is, and we can't see it because of the way the scaling is here. It's not my chart. But this is the whole point, right? The whole point is, what are the reverberations going to be? Because at the end of the day, the cost of money is ultimately what determines, right, what happens over time in a market, right? So when we're looking at how do central banks ignite risk in the repo market, well, let's look at what's happened over the past 18 months. Since this thing started, all they've been doing is printing money ad infinitum, right? Like they're just printing like there's no tomorrow. I don't know how much they've printed up to now. What's going on, AJ? Thanks for coming through. What's going on, Mike? Appreciate you coming through, brother. And here's the thing. The Fed's facility is there to make cash available, like we talked about, to primary dealers in exchange for treasury and other government-backed securities. That's how it works in the U.S. Because that's the way it's designed to work here. In Europe, it works differently. In Japan, it works differently, and so on and so forth. Yes, correct. Because as I explained earlier, when it becomes more expensive to generate leverage via collateral, what that then means is that you have to sell collateral to generate that cash that you need, because you can't just borrow that cash anymore because it's too expensive. The cost effectiveness of borrowing cash short term is gone. That's what happens when the rates of short term borrowing increases. It causes those short term markets to seize up. But it's important to understand all the hoopla that comes to that beforehand. It's just as crazy because there's a lot that goes into it, and it doesn't make sense. And that's why I have to go through the back and forth and run around in circles just to explain something that simple. Because you have a lot of moving parts that are in line with that make it confusing, right? So before all of this, the market, the Fed, the market, the way it was being treated, the Fed was offering 100 billion in overnight repo and 20 billion in 2 week repo, right? So let's just say 120 billion really short term, right? Then after things popped off, it increased by approximately 100 billion, basically. So they doubled from 120 to 220, 175, or 170 from 40. Yeah, it's 120 to 220. So they basically doubled, right? In a week, right? And nowadays, look at these numbers. On a weekly basis, the Fed is offering repo. Now we're becoming Europe in certain instances, okay? And can be moving towards Japan in terms of the length of the repos and their utility and their efficacy. Because this is one thing people have to remember, or at least realize. The longer the fiat exists, the less of a half-life it has, right? Because every fiat currency has a half-life. It doesn't last forever. It's very important people realize that. The dollar will not last forever, just like Rome didn't last forever, just like Britain didn't last forever, just like Spain didn't last forever, just like Portugal didn't last forever, just like Dutch, the Netherlands didn't last forever, right? Like nothing lasts forever unless it is true. That's why gold is so important, right? It is true always, no matter what. This is why precious metals are called precious metals, because they're always true. That's why certain gems, right, once polished, they have exquisite value because they're always true. So this is all very important stuff. So now we're at 1 trillion for short-term repos, right? Offering, right? Meaning that the Fed was willing to take on, right, to lend out $1 trillion worth of cash at any point in time, short term, right? For 1 month or less, out to 3 months or less. Now, these are crazy numbers. Because why? Isn't the economy so much better? Hasn't all of the QE that's been going on for 12 years been having its intended effect of helping the economy recover? I mean, that's what the story is. After looking at this little snippet that I got from this site, which is at the bottom, you'll see that it's not really the case, right? All of the so-called supporting mechanisms that are here to prop up the market and bring us back to normalcy have just been doing the complete opposite. They've just been draining the value out of the market. And how is that? Well, it does it in 2 ways. It makes it harder for us to accrue assets because we're still earning in fiat and we don't have a hoard of fiat to accrue assets in. And 2, as you can see, they're doing their best to ensure that asset prices are out of reach for the small guy. Because why else would you be offering up 1 trillion in short-term repo so entities can lever up their balance sheets? So they can make money, sell it back, and buy it back again. Clearly. What other what other narrative can there be? Right? What other narrative can there be but that? So let's wrap this up. In the short, the Fed is now willing to loan what is essentially an unlimited amount of money to the markets, and the uptake has fallen well below the amounts offered, right? So here's the thing. They're willing to give up $1 trillion, but they're not willing to loan out $1 trillion. Why does that matter? Because now we're at a point where they're removing liquidity from the market altogether. So what in the hell is happening out there? Good question. I think this is when we start looking at my favorite spread, which is the U.S. to 2-year Fed funds rate, and I'll explain this one a little bit shortly. Let me just get rid of the things we do not need and set this chart up in a way that makes it visible for us to enjoy. And let's give it some time duration here. Let's give it 5 days per. Okay. So let's see. If you guys got any questions, let me know because I really haven't been paying attention to the chat. I've just been rambling on and trying to explain this so that the whole picture is clear, because I know I ramble a lot. I know my explanations are very drawn out, and I just want people to understand that is because what I'm explaining is very involved, and it involves a lot of pieces, and I need people to understand that a lot of what we think we know isn't real, right? So in order to really see the big picture, you kind of have to see, you have to, hold on, guys. You kind of have to understand all of the nuances, right, that are going on, all the reverberations that could come of what's going on in the background, because it's always about the background, right? It's never about what's in our faces, because it's important to remember that it's always what we don't see that gets us, not what we see. So, always remember that, because in the markets, when you don't have control over what is causing somebody else to buy or sell, it's important that you understand why somebody is buying or selling, at least, if not have some type of idea of why people could be, right? Because you want to be able to understand what could potentially be happening. It's not to just be ignored. This is how people end up getting wrecked, right? This is how people end up getting screwed over by, oh, I didn't see that coming, and oh, it's different this time. It's never different this time. Don't believe that. I mean, even the Bitcoin stock to flow model has been altered over time, right? Nothing stays the same forever. And this is why we have to look at a little bit of everything. Now, I got 20 minutes left before Maddie starts. Let me get into this. As you guys know, MACD above zero is bullish. RSI above zero is bullish. Now, when this spread goes up, right, means typically rates are going up. Now, where do I get that idea from? Well, let's just throw this in here. And if I don't get to touch the charts today, what I'll do is I'll just make a chart set video special just for you guys, and I'll dump it in Twitter later. Not a problem with me at all. So let me just throw let's do the 10-year rate, because that's the one a lot of things are priced on here in the US. So let's see here. Okay, let's make it look pretty. And I intended to do the charts, but this topic is really what matters most here. So I really wanted to just make sure everybody understands that. You guys can see the charts anytime. But understanding this information, this isn't stuff we're going to talk about all the time. So I just felt it was more important to make sure we spent a nice, decent amount of time on that versus things that don't really matter. Because we talk about them all the time. Yes, that is right, Value. We only want knowledge drops here, right? What we only really want was going to help us make the right decision at the end of the day. So again, this is a spread, right? The blue line is the 2-year versus the Fed funds year spread. And what we're doing is we're looking at the difference between the 2-year rate and the short-term overnight rate, right? So the 2-year rate right now, as you guys are looking at right here, is 15.15% basically. And now the overnight rate is 0.06%. So the difference between the two is about 0.09%. 0.09%. Okay. So the cost to borrow, right, is doing its own thing versus this spread, because this spread highlights moments in time where crises are about to occur. Now, why is that? Well, it's because you have to remember the cost of borrow is everything, right? That is what determines the value of everything, right? If this is why assets are at the moon, right? The cost of borrow is zero. So if you can get your hands on money, well, guess what? You can buy as much assets as possible. And I should do a special on the SMB just so you guys can see how SMB and the JGB, Swiss National Bank, and the Japanese JGB, BOJ, Bank of Japan, which is the Japanese central bank, because they really go hard in printing money and buying assets, and they don't give a shit to let you know, right? And these are the kind of things that if you live in those jurisdictions, you need to know because it affects your cost of living big time, you know, and those are the kind of things you really need to be aware of. Will you please explain how the staking and a staking price t-shirt rate? Okay, not a problem, Devin C. We'll attack that. We'll attack that. I'll attack that at some point. Let me just get through this because I don't want to leave people hanging and then start talking about the t-shirt rate. This is specifically a macro stream, and the macro streams are just here to highlight what's going on so that people can understand that they're properly positioned in the first place. We'll talk about Hex specifically and strictly at the appropriate points in time. This is really a high-level conversation, not a very granular one, but I will try to get to it. Even if I do cross over a little bit into Maddie's time, just for you, you can stick around, not a problem. So what we're looking at here, right, is at this point in time, the S&P, well, I should really just add something. The 10-year rate was going down, right? It was going down while the spread was going up. So what this meant here is that the cost of borrowing at the 2-year point in time was higher than the cost of borrowing overnight, which makes sense, right? It should make sense for the duration to be, if it's longer, for the cost of borrow to be higher because there's more risk inherent with more time, right? So that makes sense. But then we got to ask ourselves, well, why is the 10-year going down if this is what's happening? Well, that's curve compression, right? Now, let me try to add one more compare in here because it's so critical that we understand what's going on. And maybe I'll add this in a left scale. Yeah. Oh, this one needs to be logged though. Okay. So let me zoom this in a little bit just so you guys can see the full effect of what I'm talking about. So here we have the S&P 500. Let me make this red, make it a little different. Okay, make it pink just for visibility's sake. And let me remove these trend line determinants here. Okay, so the pink line is the S&P, the blue line is the spread, and the orange line is the 10-year, right? So when the 10-year starts going down, that typically means we're going to start seeing some economic stresses, i.e. down moves in the market. And that's ultimately what happens, right? We see that here with prices going sideways to a little bit up and then ultimately leads to a crash in the early 90s. And this is what we're seeing here, right? We see the market kind of take a downward move since then, right, in terms of the rate. But this has multiple implications, right? Because we know that the cost of borrow has been manipulated this whole time. This is what we've seen, right, with the Fed doing all their printing and all of their monetary policy, right? And just so we remember, any economy, right, the private sector is us, the public sector is all of those that are part of the government, right? So taxes, you know, all taxes that you pay, all municipality tax, you know, all taxes in municipality, all levels of government fall into this bucket, right? So when government gets bigger, the economy actually gets smaller because the government is only really there to support society. They're not supposed to be a nexus. They're not supposed to be important. They're not supposed to be so big that they matter to the point that they employ millions of people. Government isn't supposed to be that big, but it is. And this is why we have such a crappy economy, right? The US economy specifically is like 65, 66% consumption only. However, 30% of our economy is actually determined by taxation because everybody works for at least a third of the year to pay taxes, right? And the consumers are not the big spenders, right? It's really not anybody but the average consumer, right? This is who determines an economy. This is why the U.S. economy is a consumption-based economy, but yet you work for a third of the year for the government. This is why the economy goes nowhere. This is why your economic security goes nowhere unless you have a second stream of income, right? And that's what's important to understand. So all of these nuances, right, they matter, right? While they seem like they don't, they do, because rates go up and down, but there's also a lot of manipulation inherent in the market, right? So it's important to know when you're seeing that and when you're not, right? Let's take a look at what happened in the late 90s, for example, because here's the thing, right? This is a long-term chart that's showing 13 days per candle. So what looks like nothing here was pretty significant back then, because look at here. You have a 59% drop over 182 days on this measure here. From here, which is May 25th, 1990, to here, right? Oh, I can't even see. But you guys see the dates down here from May 25th to November 1990. Like this is what you're gonna see every time Hexy's making all-time highs, right? Like these are very small blips in time, because time is always passing. Now let's look at this one here. 82%, and you can't even see it. Like these are the kind of things that, you know, I like to bring to light to the community so they can understand what it is they're analyzing and how impactful it is to analyze something in the correct way, right? We always like to look at things with the correct perspective so that we're making the correct decision, because that's what it's all about over here. Now, if we measure this move, right, because we just measured, now this is a couple of moves, it looks like, from 94, yeah, January 94 through October 94. Now, let's see what this move is here. That's a 25% drop, okay? Just in this little period of time here. And let's measure this again. Now for the spread, right? The spread popped prior to that. That's what spreads do, right? Because this is a cost of money, right? So when it pops, it means that the short-term rate is actually higher than the longer-term rate, because this number should always be going down, right? If it's going up, that means there's a stress in the market. Now that stress and the cost of borrow was to the tune of 30%, right? In the spread itself. That's a pretty significant jump in the cost, right? And this is really what it's all about, just the cost of money, right? I really don't want to keep getting too into the weeds with this macro stuff, but you have the rate looking like it's ready to go up again, which ultimately causes downturns in risk asset prices, right? We've already had a 320% jump in the cost of borrow happen once before, which ultimately led, right, because it takes time for capital implications to flow through the market, to a 50% drop in the market, right, in 2018, right? And as of late, the cost of borrow has increased, right, from summer 2019 up, well, let's just go to now, by 111%, right? That's what's happening in real time. But yet what we're seeing is the long end is decreasing, but now it eventually started increasing, right? So let's just take a look at what these spreads are doing independently, and then we'll wrap it up because we got a few minutes left. Because I just really want to drive this point home, right? So the 2-year has basically been going down nonstop since 2018, okay? If we break this chart down a little bit further, just flat. Now let's just make this candle just to make it clearer for people. You know, the true price action, right? Let's make this 1 day. Right, like you guys are seeing, it's really doing nothing, right? So now let's take a look at the Fed funds rate. Fed funds rate is weird when you're looking at it on a chart because you guys got to remember this is a controlled rate, right? This is what the Fed determines is whatever they want it to be. Ultimately, we don't get to have a say or much in that because the Fed is the one that determines this rate at all times. Now, when something happens in the market that forces them to change it, or the market forces a change, then they have to change it, right? Because at one point, as you guys can see, almost about 8 months ago, the rate was 10 basis points, 0.1%. But the Fed ultimately ratcheted that down, and it did go up as high as 2.4%, right? Because this is the rate that they're setting over time, and this is all that is. So while the rate has been going down, right? Now let me compare this to the 2-year. I think that'll be more constructive for us. Nope. How do I? Here we go. All right. Okay. Yes, this is great. This works great. Okay, so let me make this a line actually. Boom. Perfect. Okay. So while the Fed's fund rate was flying sky high, the 2-year was saying, "Oh, we got problems," and the Fed wasn't aware that they had problems. That's why you had this happening at the time, right? Which was compression, right? So the 2-year is now compressing. It's going down. The Fed funds, it took it, let's see, from November to July to catch up. The Fed did not catch up until they cut rates, and that didn't really happen until August, right? So almost a whole year for the Fed to catch up to what they needed to do, right? And then after that, you had that repo market situation happen in September, which led them to cut rates further, right? To the tune of 25 basis points. Or was that 20? 15 plus 5 is 20. They went from 204 to 184. That's 20 basis point cut in 1 month, right? And these are the kind of things that I like to bring people's attention to because you're not going to really see this anywhere else, right? So now it's time to watch what the 2-year is going to do or what is going to actually happen on the long end of the curve and what effects is going to have on the short term. Because right now it looks like rates are going to compress, right? Because a lot of the times the long end of the curve leads because that's where the sensitivity to risk is at most. Okay, and that's kind of what I wanted to really bring to the table, just talking about interest rates, how it's going to affect risk assets, why that matters. And it matters because risk assets are priced off of the lending or the contracting and lending that the Fed does over time. And this is why we went over the repo market today because, well, guess what? The Fed just took away $500 billion, which is $500 billion in cash yesterday alone, right? I mean, just look at these spikes in this chart, right? And let's go back to, hold on, let me make sure. Okay, right. And yes, I'm keeping this open so I can F5 at all times and make sure I don't miss anything. And I recommend you guys do the same because I don't know what other way to keep abreast of it because they'll post it on the website first before you even hear about it on Telegram. That's a pro tip. So yeah. So let's take a look at just this one more time. Come on. Stop messing with me. All right. So Firefox just doesn't want to work right now. Give me a second, guys. Of course, it's when it's time to end the stream. Come on. Really? All right, this thing really does not want to work. This is great. Give me a second, guys. Technical difficulties of the stupid variety. This is very annoying. Okay. Well, this is annoying, and now I have to redo everything. All right. Give me a second, guys. This will be this, and then we'll wrap it up, because Maddie is starting basically now, and I don't want to run into his time, because I want you guys to watch his stream, and I also want to watch it as well. Okay. So, geez, I forgot what I was going to say. Okay, so yeah, let's look at this, right? What happened in 2018 versus now, right? Now, let's just shorten this down a bit. 5 days. Let's make it 3 instead. Okay. So now we're looking at the most recent, right? Now, 2018, you have some pretty significant spikes and the drainage that's been happening in the overnight repo. That's been causing compression. The rate was at, the 10-year rate was at 1.7. We are now down 1.6, 1.59. So the question is that long-term rate going to roll over again? And is it going to take the Fed a year to catch up again? That's really what we need to be aware of, because everything that affects legacy markets ultimately does affect the crypto markets. And that's really what I wanted to say. I wanted to highlight what, where, when, and how. And let's head over to Maddie's stream, guys. Thank you for joining. I appreciate all the donations that you guys made today. Incredible. I'm elated, and we are at all-time highs. Let's not forget that, because as you guys know, it's always up and to the right. Whales out.